Chapter 11. Technical Analysis for Crypto. Section 1. Market Structure. Market structure is the bigger pattern price forms over time, and it helps you see who's in control, buyers, sellers, or neither. Instead of getting stuck on one dramatic candle, compare price to prior highs and lows and ask a simple question. Are we trending up, trending down, or just moving sideways? In crypto especially, that broader view helps separate short-term noise from a change that may actually matter. Most price charts fit into three broad market states: bullish, bearish, or range-bound. In a bullish structure, buyers keep pushing above prior peaks and defending pullbacks with higher lows. In a bearish structure, sellers stay in control, pressing price down as rallies fail below earlier highs. When price keeps making similar highs and similar lows, the market is ranging, which usually means neither side has a clear edge and trend assumptions are weaker. Market structure starts with swing highs and swing lows. A swing high is a clear local peak before price pulls back, and a swing low is a clear trough before it bounces. Focus on the obvious turning points, not every small wick, because those cleaner swings act as anchor levels and give you the best comparison points for judging whether a trend is continuing, weakening, or starting to change. Start by marking the obvious swing highs and swing lows. Then use at least two meaningful highs and two lows to see whether price is making higher swings, lower swings, or staying fairly flat. As each new turn forms, compare it with the last one. In an uptrend, a break above the recent swing high can support continuation, while a break below the pattern can be an early clue that the trend may be shifting. Price shows the move, but volume tells you how many traders are really behind it, so a breakout on strong volume is usually more convincing than one that happens quietly and fades. The order book adds another layer by showing bids, asks, and available liquidity, and in crypto that matters a lot because trading runs 24/7, liquidity can vary across exchanges, and thin books mean even small orders or sudden news can push price around and create misleading moves. Start with the daily or 4-hour chart, because the larger structure usually tells you the true direction of the market. Then zoom into the 1-hour or 15-minute chart for detail and entries, keeping in mind that a strong short-term rally can be just a counter-trend bounce inside a bigger bearish trend. Bullish structure is just a sequence of stronger swings. Bitcoin moves from 30,000 Servidori center to 32,000, pulls back only to 31,000 Serdio, then pushes up to 33,500, showing buyers defended a higher low and then made a higher high. Bearish structure is the opposite. Ethereum falls from 2,000 Serdio to $1,950, then drops to $1,700, to $1,800 to $1,500. With price then right bind swinger ray, made it quantiquai. Which it is stand for like. A range is what you get when price isn't really trending, just bouncing between support and resistance. In Solana, if it keeps moving between about 145 and 155, with repeated rejections near the top and rebounds near the bottom, that suggests balance rather than momentum in either direction. The key is patience. If you force a trend label onto a range, you can make poor trades, so it's usually better to wait for a confirmed breakout above resistance or a breakdown below sub. Market structure is practical because it gives you visible levels to build a trade plan around. You can use it to stay aligned with the dominant trend, look for entries near stronger support or resistance, place stops around meaningful swing points, and set targets near prior highs or lows. It won't predict the next move, but it can help you make more disciplined decisions and improve your odds. The biggest mistakes usually come from reading too much into noisy price action, like treating every wick as a major swing or forgetting to check the higher time frame first. Structure can guide your bias, but it does not guarantee the next move, and false breakouts are much more common when volume is weak or the order book is thin. A simple way to reduce that risk is to wait for stronger confirmation, such as a candle close beyond the level or clearer participation coming into the move. And some. Try this as a quick routine. Open the 4-hour Sol chart, mark the last 4 clear swing highs and lows, and then decide whether price is making a bullish trend, a bearish trend, or just moving in a range. Write down the most recent swing high and swing low, notice whether price is approaching support or resistance, and check if volume looks strong enough to support a real breakout or breakdown. If you want one extra layer of confidence, Compare that 4-hour structure with the daily chart and see I.